Hello, stock and options traders. This is Price Headley, founder of BigTrends.com. Excited to be with you to share some tips on risk management for traders. We're going to jump right into it. And as we do, just a reminder that everything we talk about here is for your information and education only. Nothing should be considered a specific recommendation to buy or sell a particular investment. On today's presentation, as you know, you are solely responsible for your own investment decisions. Big Trends and the staff are not responsible for trades you choose to make. Do consult your tax advisors and everything, and make sure you always keep that in mind before you make any investment that affects your financial future. So a few key concepts. Some of them are very simple. I'm a big believer in the KISS principle. Keep it as simple as possible. But a good rule of thumb is not get too swung to one extreme or the other in the market. Don't be all bullish in calls or all bearish in puts. It's good to be balanced. By the time I'm really getting bullish with, say, 3 calls, I'm thinking I need a put to offset it. If I can be fairly even or just even have a slight bias of a couple calls per put, a couple puts per call, that's to me all the better to say. There's always a bull market or a bear market somewhere. You just don't want to go all in. If the market goes against you, then you all of a sudden get caught up in a wave of stop outs, which we're trying to minimize that drawdown risk. And you can also hedge it, of course, using not just various stocks, but of course you could use something like the SPY, the ETF. So if you got some calls on individual stocks, you could buy an S&P put that helps to give you some insurance in case of a market pullback. The other thing that you want to do is limit your size of your open losing trades. This means don't let your losers grow too much, right? You've got to cut the dead weight in your portfolio. As you know, bad trades will weigh your portfolio and your results down. We want more good, let the winners ride longer. We want to get rid of the losers more quickly. And that's typically what traders do badly on both ends. Most people hold their losers too long and then take their profits too quickly and say, hey, you can't go broke taking a profit. If you take small profits and big losses, you can. Okay, so you want to make sure that, hey, your capital is not just stuck, even sideways, even not up or down that much, has what we call an opportunity cost on that, right? Your opportunity cost is basically saying, I could be in something else. Even if I'm up 10 or 20%, something else could have doubled up 100%. There's an 80% plus opportunity cost on that money, right? So you can always want to keep that in mind, that you don't have to think in such absolute terms about, am I up or down on XYZ stock? But what if I was in ABC stock or another name instead, right? So, and also the idea that losers hanging around starts to mess with your emotions. You start second guessing yourself, saying, I should have gotten out of that earlier. Usually, as you say, how do big losses start out? They start out as small losses. My experience is typically when I'm right very quickly. And if I'm not right, better to listen to the market and say, head for the exits and move on and kind of clear that weight psychologically as well as financially out of your portfolio. Love this graphics, dog. Don't bite off more than you can chew, right? The idea here is that, it's just too much and a choking hazard there for that pup. But bottom line is that you don't want to choke on too many big positions and frankly too many total positions that you then lose track of something slipping through the cracks. So we'd like to think in terms of both full positions and also half positions. So sometimes what we'll do is we'll be peeling off some exposure on half of a winning trade, trying to let the other half run. So that could take us down from one trade to a half. And then you do that a couple times, you've opened up room for one more full trade to be added back somewhere else. Or you could look at it as several half positions that you might have building exposure to. The idea being that you don't have to be all in right away. You can always look for some validation that you're on the right side of the trend. You want to look to add to winners. I've developed a method of big trends. It's called the retest method that looks for ways to kind of add into a good trend on good low risk reentry points. This also will prevent you from over trading, or what some people might even call revenge trading, where you have a losing day the day before, you come back and say, I'm going to get all that back and then some the next day. And that's not how you want to think. You want to think, is the structure right for me to make money in this market? If it's been a market that's not working for my method, probably should be trading it smaller and really cutting back my size to make sure that then we start to see things getting that validation where we can get back to a more full-sized exposure. So exposure in general, risk exposure and portfolio exposure, very important. As you can see, with options especially, we're saying don't invest more than half of your account at any one time is a good rule of thumb. That's more than enough because a lot of times you're using a leveraged vehicle that might have 10, 15, 20 to 1 leverage. You can control a whole lot of capital with only half of your money invested, keeping some cash on the sidelines. a good overall idea. Sure, for equities, a lot of people like to stay pretty fully invested during bull markets. Maybe if there's a bear market signal, like a break under a 200-day moving average or something like that, you might say on the markets, that might be a, hey, watch out, maybe I need to cut back some of my even equity exposure below the usual relatively fully invested equity mindset. So this will limit your risk, but also the size of your drawdowns, right? Drawdowns are really what we're trying to make sure. That's what's kept me in the game for over 30 plus years of options and stock trading, is knowing that my drawdown management is going to be the key to hanging on to more of what I make. No more than 10% of your portfolio shall be allocated to one sector. I mean, as you know, there was a point where the tech sector got up to some insane number, like 40% of the total S&P at one point or something silly. That's too much exposure for tech in the overall market, and that's why we had a bit of a retracement last year. Some of that came back, that fluff came back out, and those numbers got a little closer to a reasonable percentage of tech within the overall market. Same idea for your own portfolio. The idea being, of course, we could have a couple half positions on a couple of different tech names if we're putting, say, 10% into each trade. That would be like 5 and 5% going into to make 10, or one full 10% position in one particular name, whether it's tech, healthcare, industrial, financial, et cetera. Trying to stay diversified in the best of the best, or for bearish trades, the worst of the worst, where we get steady, persistent trends. That will allow you to be diversified without getting what I would call deworsified, meaning that if you put into too many different things, you'll have too many laggards, right? You still want to say we don't need to be all in. We can pick our spots, find the best sectors. There's an old saying that says, you know what, I'd rather own the worst stock in the best sector than the best stock in the worst sector. So sectors are important. Sectors meaning, segments of the economy, tech, healthcare, like we just said, and you could even tap international into that to a degree. And some of the ETFs that can give you a lot more choices, where you can actually say, okay, you can actually start to get some exposure to some other areas that might be less correlated with the typical U.S. equity market. Biggest obstacle for most traders is this. You see this big chasm here on this picture here. It's the drawdowns. How deep do you have to go before you get to the next peak, right? If you've made it to this peak, you'd like it to be something that's a little more manageable like this, not the V that it shows on that picture there, right? That's too steep of a drop. Because the whole thing is that you not only got to be able to survive those drawdowns financially, but you've got to be able to survive them psychologically, emotionally. So it's both pieces. And what we always say is that if your typical drawdown is 20%, and you say, I know what my drawdown is, I've looked at decades of data and it's typically 20%. I would say psychologically and financially, be prepared and ready to handle twice the maximum drawdown. In that case, instead of 20% being your typical, say, what if it goes down 40? Could you handle that? Are you ready to continue to trade through it? Or do you have some other plans that you're going to help to mitigate that? That's where money management discipline, as well as kind of what we call equity curve portfolio management, comes in. It's a little more advanced, but we handle it for our Big Trends coaching students. But the idea is that you've got to be able to control your risk and make sure that you don't give back too much or all of what you've made. That's the thing. You work hard as a trader. You spend a lot of time in that. You've got to also break down what's the return per hour that you're investing in trading the markets, following the markets, learning about the markets. And we want it to be the best return possible. That's where our coaching program comes in for a lot of even fairly experienced traders with our very in-depth 40 plus modules. We call it Triple Crown Coaching. You can contact us, coach@bigtrends.com, if you have questions on that or anything else we talked about here, or you can also call our 800 Big Trends number, toll free, 1-800-244-8736. So I look forward to hearing from you. Let me know what you thought about this risk management session. I know it's short, but we tried to pack a lot of good content in to really keep you focused on some core actionable ideas you can use to limit your risk and also still participate in the best moves across the best sectors and stocks and options in the market. Thanks so much, and I hope you enjoy this risk management series. Take care and trade well.